Thank you very much. Thank you to Susan. Thank you to Martha for the invitation to be here. I'm really thrilled to be party to the conversations that you're having at such an exciting time in the development of your childcare and ECE sector here. I'm obviously from foreign... Sorry, Martha, talk louder? Oh, right into it, okay. If I'm speaking too quickly with my accent as well, you can give me a different signal, maybe that, and I'll slow down a small bit. So I'm definitely here as the canary in the coal mine, I think, having listened to the talks this morning, and I'm sorry to bring such pessimistic news about overseas childcare markets, but hopefully some of the things I'll talk about today you won't ever have to deal with. And by me being here, if that's the case, then I feel like I've earned my flight here today. So Susan's asked me to speak directly to the issue of private equity investment in childcare markets. And so the contexts I'm most familiar with are those Anglophone contexts that Gordon's already alluded to: Australia, the UK, New Zealand, where I'm obviously based. I think I'm obviously based. I don't know if I said that. And these are markets which have experienced significant consolidation in terms of their market share over certainly in the for-profit sector. So they would have traditionally been seen as fragmented markets, and in the trade literature, they would have traditionally been known as sort of individual owner-operator markets. But in the last 5 to 10 years, we've seen rapid consolidation happening in those markets, both from owner-operators trying to extend in the face of new funding streams, but what I'll speak about more directly today, by the interests of outside capital, by investment funds interested in the childcare sector for a range of reasons I'll talk about shortly, and in the process buying up or consolidating ownership. It's more pronounced in some places than others. Certainly the UK and Australia are quite advanced. There's I think it's about 20% of the for-profit sector, 15 to 20% is private equity owned, and I'll explain in a moment what I mean by that. New Zealand slightly less, but because of the fast pace at which this part of the investment sector works, it can change quite rapidly. And so that's roughly where we're at the moment. So in the context of that broader consolidation that we're seeing happening in these more advanced childcare markets, I'll talk about three things. Firstly, what I think equity capital is, what equity investment looks like more generally. Give some examples of what it looks like in relation to childcare, so what's it actually doing on the ground. And then finally close up with some comments where I will try and identify, if I haven't already by the end, the potential challenges of working with this form of investment when we're trying to reach the kinds of ambitions we have for a good quality, affordable and equitable sector going forward. So if, like me, you're probably wondering what the difference between equity investment capital in childcare is compared to what we've sort of known for a little while, which is sort of shareholder investments, institutional investment in childcare, which has been around for quite some time. We've all heard about the ABC childcares of the world, etc. And there are notable differences which I'll address. But firstly, private equity investment, what is it essentially? It's quite a slippery thing to get a handle on, but in essence, it's basically private equity firms who manage and invest a significant amount of capital or money on behalf of either high net worth individuals or on behalf of other kinds of investors like pension funds. Post, and the broader context here, post the financial crisis in 2008 and onwards, we've seen a significant shift in orientation of some of these funds from the more traditional kinds of things we've become familiar with, of the derivative markets and all these kinds of financial entities, to looking for other kinds of investment options which seem much more secure. And in that context, social care generally, but certainly childcare, as we're talking about today, has become a really interesting fix for them. And the reason it seems interesting is in large part because it seems like a government-backed business in terms of the funding streams that's coming through to the childcare sectors and also the political lock-in around that funding. So it looks like a long-term commitment. We're not in a position to pull funding very easily once it's introduced. That coupled with high and rising parental fees, there's very strong income streams, and it looks like a really secure option for these kinds of investment vehicles. And so that's the sort of broader context. So there's lots of talk about intergenerational relationships with regards to childcare and aged care, but I think there's some interesting financial tensions around that relationship as well. What makes equity investment different to publicly traded companies, which we're more familiar with perhaps, the sort of shareholder companies that we're used to hearing about? There's a few different things, I think. Oh, the slide's already changed, thank you. Firstly, it's how I think private equity would view childcare as a financial asset. And hopefully I'll be able to describe this in more detail as we move through the next slide or two. But essentially what I'm trying to get at there is the way in which the childcare service or chain is viewed as much as an on-paper entity which can be manipulated in terms of its financial credentials as it is an on-the-ground service that serves the communities of interest that we know it needs to. So it's in a lot of ways very much removed, and a lot of the business of it is very much removed from what's happening on the ground. And so I think that financial component is really important, that assetization in a sense. Secondly, equity investment is in essence founded on debt and expansion. So it's a business model which is essentially works to favourable conditions. Once sort of interest rates are low, for example, it's a very fast time horizon where it acquires debt, builds up debt on behalf of the investment fund to expand into a whole range of businesses. Childcare is both one. And in the process, we'll take on a lot of financial risk in order to do that because the fund closes down within that short time horizon. So we're talking maybe 5 to 7 years. We're not talking long-term commitments here in terms of that financial payoff. So it's a very much a make hay while the sun shines business model. Thirdly, once a company is purchased, and I'll give an example of a specific childcare example shortly, but once a company becomes purchased, it's often used to leverage further debt. So the company can become the means through which further debt can be taken out, and then that company becomes saddled with the debt servicing for the parent company. So you can see the sort of volatility that's inbuilt in this system, probably just from what I've said so far. And we know with debt, it has to be met irrespective of your performance, your business performance, unlike shareholder, or a bit different to shareholder traded companies where if there's a soft year, you might have a poor dividend payout. This is debt which has to be met. And so you can imagine the sort of financial strain that puts on the company that's leveraged off. Lastly, and importantly in regards to some of the discussions around guardrails we've had so far. In terms of government insight, it's very well acknowledged in the accountancy literature that there's a significant lack of transparency and accountability associated with companies who are owned by private equity firms. They don't have to meet anywhere near the same reporting standards. It's a very opaque side of the business world, and even in terms of trying to research it, it's an extremely difficult space to try and understand. It's deliberately opaque. So for all of these reasons, I think it marks a notable shift in the corporatisation of childcare from what we already know as childcare advocates and researchers. So what do we know about the involvement of equity capital in childcare markets internationally this far? And I'm really fortunate to be able to lean on some excellent research which has come out in the last couple of years. One is from Australia, and it's the Big Step United Workers Union report on the left here. And the second is a really incredibly robust research report which Professor Eva Lloyd at the back of the room was involved, co-author on, which looked into the business operations of the top 5 to 10 for-profit private equity in particular firms in the UK, looking at their business models and thinking about the kinds of activities that's happening in those two markets. So what I'm going to talk about will lean on that empirical research quite a bit. So both of those reports have a lot of commonality in terms of their findings. Looking at the business activities of equity investment, these reports identify clear patterns of behaviour, so they're really in step with each other. They note a process of very fast-paced acquisition and merger. So because of the amount of significant capital that these funds wield, they can quickly move into a market, purchase at pace, and roll up companies, childcare chains, relatively rapidly, really, compared to say, an owner-operator model or some other options we might have. The word churn comes up quite a lot to try and describe just the volatility that these kinds of entities create once they enter these childcare markets, because they often drive up the price of the childcare services themselves. There's all sorts of economic and accounting sort of tensions in there too. Ownership consolidation occurs through buying up smaller individual owner-operators, but also more recently, as we see in the UK market, by amalgamating medium to larger size chains. And what we can see happening there is the production of these services with 300-400 chains with 300 to 400 services. So we're in the sort of territory of the sort of ABC childcare collapse and the sort of too big to fail domain. We're back sort of in that sort of space, I think. The reports also note the different ways that childcare companies are rendered into a sort of financial asset. And for me, this is really interesting in thinking about just the kind of business optic that's applied to these childcare entities in order to make them financially lucrative or to derive new income streams from them. This happens in one way through the purchase of the childcare chain, its restructure through some of the things we've talked about today, cost saving through labour, undermining workplace pay rates, etc. But also through the on-paper calculations. So often the childcare chains, their value on paper is increased through the inflation of things like goodwill or intangible sort of assets in order to make them look more valuable than what they've originally been purchased for. The reason there is to either sell on quite quickly at a profit or to then use that more highly valued business to then acquire more debt. So to use it to access more loans, where the childcare chain then becomes, again, saddled with debt servicing to repay that loan. So it's the operating company rather than the parent company who is sort of saddled with that debt in a sense. So that's the second way this financialization process works. And the third, another strategy which is open to, available to private equity in a sense as an option, is to disentangle the built environment from the license to operate. So we're seeing a changing of ownership of the property, either selling it on to a real estate investment trust or some other passive rentier in a sense, where that's their profit comes from the rentership of the property, where the license to operate remains with the original company. And so the pressure of rent over time is what sort of really presses downward pressure on the operating ability of that business as well. So there's all sorts of ways in which this becomes a financial asset through that sort of business lens. And so to put this into a wee bit of specific context, I'm going to return back to the UK Acquisitions and Merger Report and just walk through one example they detail in that report, which is Just Childcare. It was purchased by an equity investment group, an overseas one, in 2015. And while the company had been reporting a profit up until that point, once it was acquired, it stopped reporting a profit. Most likely because it had taken on a lot of debt. And we know that debts are deducted from the profit, and so that's probably why the profits weren't being recorded, but also not returning a profit or reporting a profit means your tax liability is reduced. And so this seems to be a very common strategy. At the same time, Just Childcare grew in size from 20 services to 60 services over the next 5 years, despite not reporting a profit. And this, what's called growth through loss-making strategy, seems to be quite common and identified across both reports. Figure 1 here is taken from the Big Steps report, and it gives you an indication of the 2020 figures for their top 5 childcare chains, looking at their income, their outgoings, the amount of profit that they report, and the amount of tax paid. So you can see this is a fairly common financial calculation. And I think the ability of domestic corporate governance rules to try and manage and apprehend what's even happening in this space is really limited, in part because of the geographic dispersal of these business entities, which I'll speak about in a moment, but also because of the business complexity. The second figure is taken from a recent UK Guardian article, which there's a series of investigative pieces on private equity investment in childcare. And again, it focused on just childcare, which is useful for me because it gives me an illustrative example. But it gives you a sense of the levels of subsidiary groups that exist between the childcare company and the parent company. And that's primarily there for liability, insulation against financial liability. So in terms of tracing and tracking the operations of some of these kinds of entities, if we're prepared to go down this road, it's extremely opaque and it's very, very challenging. Do I have another slide? I don't, sorry. Thank you. So I think it's undoubtedly the case, as we see consolidation happening in these quite advanced marketized systems, that the voice and power of the for-profit sector, and certainly the more corporatized part of the sector, becomes stronger. And it's in no small way, I think, advanced through the voice of these private equity actors. And in the process, a large part of their claim tends to be about highlighting the benefits that they can bring. And Gordon's already dispelled some of the myths that we have, I think, around some of the purported benefits of corporate and certainly childcare, for-profit childcare at scale. So some of the benefits, just to reiterate, might be, you would assume, if they're operating at scale, that they would be able to offer childcare cheaper. We might also assume that because of the amount of capital that they wield, they would be able to proliferate childcare places more quickly than, say, the owner-operator or the not-for-profit, as we've already talked about today, meeting that vacuum between supply and demand that we all know is sort of really on the table here at the moment. However, from the research that's out there, certainly with regard to private equity, there is very little evidence to say that that business model meets these needs, that that's actually what they're doing. For example, as Gordon's already discussed, the childcare costs are amongst the highest in the OECD, both in Australia, in the UK and in New Zealand. So cost is not being reduced. If there are efficiencies, it's not getting through to the parents. As the acquisition and mergers document highlighted with regard to just childcare, even though they went from 20 to 60 services in 5 years, only one of those services was a brand new service. So we're not getting any new supply. We're really getting a sort of a roll-up of services. That's not part of their financial horizon. They're only there for 5 to 7 years. It's not in their interest. So as an actor in this space, the value added really isn't clear from the kind of objectives we have going forward in terms of what we want to achieve with the kinds of investment we have from government. And I think, if anything, we're actually losing some of the purported benefits of competition. And even though we have a big question mark over that generally, but if we have this rationalisation, we're not getting the benefits of a diversified childcare market. Parents don't have the same level of choice, if that's a thing that really matters in terms of their ability to move around, which Gordon's again dispelled some of those myths very effectively earlier on. So meeting head on some of these purported benefits, I think, is really important. And the kinds of data that we have, and I echo Gordon's concern there, is super important going forward. How we evidence some of these things, the amount of information, not just that we have as researchers, but as ministries, the methodologies, the scope with which we investigate this sort of sector is really, really important, I think, personally, going forward. And that's one of the real frontiers, I think, that we need to grapple with to really understand where we're going to plan ahead. I'll conclude, because I'm conscious of the time. So to conclude, I'm just going to borrow an excerpt from that UK analyst I mentioned who had these wonderful graphics that I could borrow for this talk. And he recently described private equity investment in the UK as a high wire act, and I think it's actually spot on. And he set out the scenarios of this high wire act. He said inflation may push up costs of operating, but hopefully interest rates don't rise. The cost of their debt may rise, but hopefully parents can afford to pay a bit more for the increased fees. Parents then might stop paying fees, but hopefully the company hasn't just acquired a whole new set of assets and then folds as a result. So we have if any of these things happen, what happens? The company collapses. We have a very tenuous base on which all of these sort of financial activities are happening if we go down this road any further. And I think if governments hadn't, certainly New Zealand and the countries I'm familiar with, hadn't stepped in to really bail out the childcare sector to a large extent, we would have exposed an awful lot of the vulnerability in the markets that I'm talking about by now. We would have been in serious trouble. So So I don't think childcare at scale is necessarily the issue here. I think the economies of scale work across the board, and I think with increased regulatory and compliance costs, from what I've seen anyway in New Zealand, rationalisation tends to happen on a small scale. You know, individual owner-operators close up and we start to find these sort of scale economies being developed in different ways. But I think the real issue arises here with the introduction of business models which are entirely based on financialised risk-taking incentives and motives, where childcare becomes reconstituted as a financial asset to be leveraged off. So it's packaged and repackaged, sold and bought, traded and listed and delisted. You know, what is it actually? Who's benefiting from that? I'll leave that question with you. In what is understood as a sort of recession-proof sector, so it's the confidence with which these investors are taking interest is because of the lack of strong regulatory framework and the big bag of money that seems to be going into this sector. So, you know, it's not hard to see where the incentives are for them. So the continued involvement of large financial capital in childcare, I think, really exposes some of the shallowness, the political shallowness of talking about childcare as a public good. Because if we actually do see it as infrastructural, which is what I believe, to everyday economy and society, as something we might consider part of a foundational economy, then allowing it to be incorporated into very unstable debt finance systems undermines any benefits we have accrued already with this infrastructure and that we could accrue going forward. Thank you.